Hi, Vishranth. Good evening. This is Ramesh Bhatt from Krishnu Academy. On behalf of Krishnu Academy, I welcome you to our YouTube channel.
Yeah, thank you, sir. Thanks again.
And I have a question from you, Vishranth. Before I start, many of the viewers already know Mr. Vishranth. He is CEO, one of the part of co-founder of Asset Plus. And while I was talking to Vishranth, sir, yesterday casually, and Vishranth said, sir, do you know you can protect your commission, mutual fund commission, you can protect your downward. When market is going down, I can protect your commission in certain ways. We have worked out certain formulas for that. I would now love to hear from you, Vishram, that say, let us suppose Mr. A, who's an IFA, whose AUM is 5 crore and his trail commission is 1%. So for a simple calculation, I'm giving you this. So for 5 crore on it is 1% trail commission will be 5 lakh. So per month, it is around 42,000 rupees. It comes per month if you calculate. In that case, if the market is going to tank from, let us suppose market has tanked from 30%, there was a reduction in the this thing value. So 5 crore minus 3.5 crores. The 5 crore has become now, if the, because of 3.5%, 35% market has gone down, 30 to 35%. His income, that is his AUM, has gone down from 5 crore to 3.5 crore. If it is going to go down, his commission also will come down. Can we protect? That is, he always, as if we can give an insurance cover like that, that he can be taken care of that 41,600, something like that. Is there any way out? Can you give a detailed explanation on this?
Yes, sir, sure. So I think the point that you mentioned is actually very valid, especially during times like this when unfortunately the markets have fallen by 20-30%. Say 2 months before this, no one would have expected that the fall could have been this drastic. Although there has been some recovery now, by end of March, situation was much worse than it is currently. So in these times, based on our close interactions with a lot of advisors who generally are more tilted toward equity oriented, recommending equity oriented investments, what we have observed is that there is a chance that their revenue itself can take a hit, because since all of us are self-employed and we are not getting a fixed salary as such, so it might become difficult for an IFA to manage his or her cash flows during times like this. So this is something we had observed 2.5 years back. So we had been working on for quite some time, and there's a very simple strategy that we execute on a month-on-month or a quarter-on-quarter basis, which can help advisors overcome this challenge. The challenge, as you mentioned, is very simple. In case markets tank, and in case their equity AUM, which is marked to market, also falls down proportionately, their trail income, which is again marked to their AUM, is also going to fall proportionally. And what can the advisors do to ensure that it does not fall below a certain threshold? Because advisors also have commitments, they will have to have family expenses, EMIs, etc. So how can they go about this? So this is a very simple concept. So I will start off with some basic notes regarding this concept. So this involves a very simple idea of buying put options. That's it. There is
put option. Okay.
Index put options. It is as simple as that. So this is not any complicated derivative strategy where they will have to hedge and trade multiple times. Nothing along those lines. It involves a process to decide what kind of options to buy and at what quantity to buy, because that is going to vary with regard to each IFA based on their income levels. So the strategy is essentially purchasing a put option, and this is not a strategy to make money or generate profits. So this strategy purely has just one purpose. It is a hedging strategy. Say, for example, just like how an export-oriented company, say an IT solutions company based out of US, who receive their income in dollars, suddenly if the value of dollar falls, when they convert to rupees, they will take a hit. So they sell dollars and buy rupees on a monthly or quarterly basis, which is what is known as hedging. This is a much more simplified form of a hedging strategy for our IFA friends. So this is a concept. So actually what it involves is, this concept involves purchasing out of the money put options for the coming month's expiry.
I'll
So,
repeat. I'll repeat. Out of the money, put options.
Put options for the subsequent month's expiry. So, and what I'll give you an example. Say, in case, say this April month's expiry is due day after tomorrow, and if IFAs are able to purchase a put option with the expiry of May month, so that is 1 month in advance, if they are able to make sufficient calculations in order to decide what put option to purchase with what strike price and how much of it, how many lots should they purchase, it is simply possible to ensure that in case markets fall a further 10, 5 or 10 or 15% in the coming month for any reason, their revenue is still safeguarded. So that is how this works. So let me take a very simple example based on some of the actual put of the strategies that we have executed. So one thing is this is suitable for IFAs whose majority of the income is dependent on mutual fund revenue. And even within mutual funds, they are having at least 70 to 80% of their income in equity oriented trail commission. Because if they have maybe only 30 or 40% in equity and remaining in gold, debt, or arbitrage, then the strategy might not be required since it is already sufficiently hedged. So, coming to the actual strategy, this involves purchasing a out of the money put option based on the current levels of market sentiment, and the strike price of the put option can vary anywhere between less than 5% of the current Nifty values or less 10% of the current Nifty value. So let me give an example of two trades. So these were two trades which on looking at our past data, we could see that this has helped reduce the loss in revenue. So this both of these happened in the past financial year. So one was during August 2019 and the second one was during March 2020. So I will give out some of the actual numbers. So if you look at as per what I had mentioned, so for August 2019, this strategy would have involved purchasing put options in July when July month was getting expired. So which was on 25th of July. So as on 25th of July, the Nifty levels were about 11,200. So plus or minus 50. That is where it was fluctuating. And if you take a 5% level below that Nifty level, because in August there were a lot of issues coming up. The markets, the general sentiment was quite low, but we were not expecting or forecasting any extreme situation. So rather than taking a 10% less strike price, we had taken a 5% less strike price. So the strike price is 10,700. So for Nifty 10,700, as on August expiry, the cost of one put option was 32 rupees. So, and we would know that one lot of Nifty is 75 rupees, 75 in number. So 75 into 32, this strategy would have cost 2,400 rupees in the month of August. So what has happened is, in hindsight, I'm giving you the numbers, but actually on 20th of July, when we made this purchase, we obviously were not aware of what is going to happen. I'm just giving an example of when it was successful. There are a lot of times when it also is not successful. So by 5th August, when Nifty started falling very drastically, it touched levels of about 10,850. The price of this put option immediately went up over the next, in that 1 week, 10-day duration to 215. So 215 from a level of 32 is where we had sold the put option. So I think that was around 16,000
profit, 183 profit into 75, which is 13,725. The gain.
Correct. Yes. So that was the total. So we sold it at up to 15, not 250. So the actual profits that came was somewhere about 13,500. But actually the put option went even up to 300 finally. But that rest of the upside is not something that we had captured. And one more strategy was during March 2020, which is by end of February, on 27th February, the Nifty levels was 11,1100. But this time what we had done is, given that China had already gone into lockdown and the last 10 days between mid-Feb to end of Feb, the fall had been drastic. Nifty was even falling 3 to 4%. And since it involved a issue of a virus coming into the picture, we wanted to be more conservative. So we have purchased the put for 10% of the strike price below the Nifty's level. So what the actual value was, we purchased Nifty 10,000 strike price. Expiry was March. And the cost of this option was 60 per option. So it came to 4,500 per lot.
16, huh?
60.
60.
Correct. So it was 60 because in the previous example I gave, the market volatility was minimal. So it was only 32 rupees. Right now, since markets had already fallen, the volatility index was higher, due to which the option prices also reflected that. We purchased it at 60 per option, which was 4,500 rupees per lot. And unexpected, although it was, by 12th of March, when Nifty touched 9,500 levels, this price went to 700 per option.
Wow.
And we, as per our strategy, we had certain metrics. As and when these profits are accumulated, we exit, because we try to do a process oriented way of exiting, just like how we buy. Because the moment we wait for emotions to take the decision, we will just end up waiting for more and more profits, and options can very easily expire worthless. So we have to be careful. We exited when the option was 700. Actually, the option went to 2,100.
Oh.
Because the markets had the most fall until 23rd, 25th of March. But we had exited in 700. So these are two of the instances in the last financial year when the strategy actually provided a profit. And there was one more instance, which I believe was in the month of, it was earlier during the financial year when this provided a profit. But apart from these 3 months, this strategy gave us a loss for the remaining 9 months, which when I say it gave us a loss, the options have expired worthless and they have gone to 0 rupees.
But one thing, Vishranth, we should treat this as an insurance premium to
Correct.
protect our commission. That's what. Insurance
Exactly.
premium to protect our commission.
Correct. So what is the assumption, underlying assumption here is that in case markets do not fall so much, because of the fact that advisors have their existing AUM and some new AUM or SIP might get added, that anyway gets compensated for the minimal 2,000, 3,000 rupees that we are deploying in options. But more importantly, during drastic cases like this, when the fall is nowhere expected, it actually comes and saves the advisor's revenue to a very high extent. In fact, many of the advisors who have diligently been deploying this, they have made twice of the revenue that they had for the month of February already, just due to this strategy. So even in case their revenue goes to 0 for the month of April and May, they are still already compensated for. But actually, revenue is not going to go down to 0. A 30% fall will entail a 30% reduction in revenue as well. So when we did some backtesting data, so when you look at this for the last 2 financial years, for the financial year that ended March 2020, deploying this option strategy on a monthly basis for 12 months would have cost somewhere between 20, it cost 20, around 20,000 rupees. And the payoff actually due to this came to 81,000 rupees.
Oh, excellent.
So this is one of the years where the volatility was high, due to which the payoff also was sufficient. But if you look at 2018, so the backtesting would have showed that the cost of deploying this strategy would have been 26,500, whereas the payoff was only 34,500. So it was only an 8,000 rupees payoff, but nevertheless profitable. But if you look at 2017, where it was a bull market and it hardly had any volatility on the negative side, the option strategy involved purchasing price was 23,300 and the payoff was 0.
Because it is limited to the premium what you pay. Put option is always the premium what you pay. Anything, there will not be any over loss. Only the premium is a loss for you.
Correct. So 23,000 odd number that was deployed by the IFAs over 12 months. For the year, it actually did not, because it was an insurance risk premium, it has gone down to 0. But I'm sure no IFAs would have complained in 2017 that their revenues have fallen, because the mark to market that happened due to the increase in markets have much more than compensated this. So this is a very simple strategy. So to just give you an outline, so we request IFAs to consider purchasing put option on the day of the expiry for the subsequent month and decide the strike price based on the market sentiment. It could be 5% if it is a general market trend without too much of a negative expectation. If IFAs want to be conservative and insure themselves more, it can be 10% of the strike price. And they also, it is very important for IFAs to fix the target at which they will exit the option, because otherwise it can lead to IFAs indefinitely waiting for the options to increase, and put options can very quickly come to 0. So what we generally recommend is the exit strategy for this should be somewhere between 30 to 50% of their revenue.
30 to 50% of the
revenue. That is a good strategy for the IFAs to take an exit from the option and book their profits. And we again, when we recommend this to advisors, we request them to treat it purely as an insurance premium and not with the aim of trading and generating profits at all. So the first step would involve the IFA putting all of this on paper, calculating his income that is coming from equity mutual fund trail, and deciding how many lots or what is the monthly premium that he or she is comfortable with to pay. This needs to be decided beforehand, and even when they will sell also needs to be decided beforehand. And very importantly, these entry points and exit points should not be changed as and when the trade is progressing, because the biggest challenge when it comes to put options or any form of futures or options trade is that emotional decisions can wreck the strategy. So this entire thing will be blown out of proportion. Although the loss is minimal, the IFA should understand the point of this strategy is only to secure their this. In many of the IFAs, we recommend this to also compare this to some form of a chit fund. If it works for them, they can call it that way, where they are making a premium in that 1 month when their revenues have taken a hit and when there's a lot of sentiment, they get to reap the benefits of what they have done over the previous months. So this is the actual strategy. We have been trying it for over close to 15 months right now. We started in 2019 January, and it had not worked out for first 6-7 months. But right now, especially after this incident, it has helped us a lot. And even moving forward, if advisors would like to say, just try this out for the upcoming month, because the volatility in the market still exists. We still do not know where the markets can be in the next 1 month. To give a very quick example, as on today, the expiry for the current fund is due in the next
2 days.
2 days.
That is on 30th. 30th it is due.
So what IFAs can look at is, just 1 second, I'm just opening up the actual data. So IFAs can look at two possible options depending on what they are comfortable with. They need not have to actually deploy. They can just watch to see how the strategy plays out if they require. So as on today, Nifty 8000 P, which is 1300 rupees less than the strike price, it is trading at 46 rupees. This is one. And Nifty 8500 P, so this is trading somewhere at 90 rupees. So if IFAs would like to have some form of an insurance, they can go ahead and purchase either of these put options currently and hold it until the expiry due is come, or until the profit this has been hit, that 30 to 50% of the revenue. What can likely happen is, in case fortunately market starts going up and markets have not witnessed a steep fall, it is possible that, very much possible that these premiums can now go to zero by the end of next expiry.
But your income is going up. Mutual fund commission is going up.
Commission is going up, so IFA would not have anything to complain. In the worst case that suddenly there's a 10% fall due to some lower circuit being triggered, or even if there's a 2-week fall of 10 to 15%, this premium that we are buying for 90 rupees for 8,400, if there's a 5% fall in Nifty, this 84 rupees will, this 90 rupees can easily go to 250 to 300 rupees. And that will give an amazing premium cover for the IFAs.
Fantastic. Fantastic.
So yes, sir, this is
you are given an eye opener. You are given an eye opener for many IFAs across the country. Only, as you rightly said, they should not misuse this. It should be treated as an insurance premium and work accordingly, not try to trade and make more money, and entirely they should not lose the money, which is very important. Hedging.
Because we have one
concept is hedging.
We do have one example of an IFA when this Nifty has gone to 700 rupees. So he had not gone ahead and sold, but rather he waited for it to go to 1,500. He kept waiting for some more time, and unfortunately in the last expiry, the Nifty option expired worthless. So he has lost some 70 to 80,000 rupees. So it is very important to not only set the entry point in place, but even the exit point should be properly process oriented. And then it's a strategy that can work very well for IFAs whose income is mostly dependent on equity mutual funds.
So not to be greedy, your advice here is not to be greedy. Use your mind wisely, book the profit.
Correct. So rather don't use your mind, just blindly follow the strategy.
Strategy. Yeah. Excellent, excellent.
Yes, sir.
Thank you, Vishranth, on behalf of Krishna Academy. We thank you very much for protecting this, especially this going to work a big way when there is a market tanking down, down and down. We are seeing certain things. It is not certain the market is not going to be, it is going to be very volatile during this 2020. Let us wait and see what things are going to happen. Thanks for your time.
Yes, sir.
God bless you.
Thank you for giving me this opportunity. Thank you.